So look, if you break your arm, right, the x-ray is pretty much binary. I mean, it's either broken or it's not.
Right, exactly. You can just point to it and say, there's the problem.
Yeah, but looking at Target's Q1 2026 earnings today, the x-ray is just a total mess. I mean, on a surface, their physical foot traffic is surging. We're talking a miraculous 4.4% jump, which, naturally has Wall Street cheering.
Oh, absolutely. I mean, everyone is celebrating that top-line traffic number.
Right. But when you look beneath the skin, they are burning through literally billions of dollars on, payroll and logistics just to manufacture that growth.
Yeah, it's a very expensive strategy.
It really is. So today we are tearing into the ticker TGT to answer one core question. Is Target actually fixed, or are they just, buying time with a very expensive Band-Aid? We are your hosts, and this is our Signature Talk Tickers breakdown.
And for anyone new to the format, we operate on 4 main principles here. First, we are data forward, meaning we anchor everything in the actual numbers from the call. Second, we use plain language. So we're stripping out all that corporate jargon. Third, we are opinionated, right? We take a firm stance on the company's strategy. And lastly, we make it actionable so you, the listener, know exactly how this impacts your portfolio.
Exactly. Earnings calls usually sound like, a robot reading a spreadsheet to put you to sleep. So we're here to translate. And the tension in this specific earnings report is just palpable.
It really is. I mean, Target dropped a massive quarter. Shares are up. But any retail analyst who's looking closely at the capital expenditure side of the ledger, they're sweating right now.
Sweating heavily.
Yeah. The sheer volume of cash they are deploying to achieve this traffic bump, it kind of changes the entire narrative of what kind of company Target is trying to be right now.
Well, let's start with the scoreboard.
Yeah.
Before we get into, the psychology of their merchandising or the whole overhaul of their supply chain, we have to look at the raw math presented by Chief Financial Officer Jim Lee.
Right, the headline numbers.
Yeah. So top line revenue, it hit $25.4 billion. That is a 6.7% increase year over year. But Jim Lee spent a really considerable amount of time pointing out that revenue is 3.7% higher than 2 years ago in 2024.
He really leaned on that.
He did. And I'm curious, why the deliberate look back to 2024? Why skip over last year?
Well, you have to remember, 2025 was a highly volatile year for retail across the board. I mean, the whole industry was plagued by these terrible supply chain hangovers and, massive shifts in consumer spending. People were moving away from buying physical goods and spending all their money on services and travel.
Right, the whole revenge travel thing.
Exactly. And retailers, they notoriously play games with timelines. If last year was an anomaly, like just a total disaster, they will point to year-over-year growth and claim a massive victory.
Like, look how much we improved, when really they just stopped bleeding.
Exactly. So by forcing the comparison to 2024, Target's management is trying to prove that this isn't just some dead cat bounce or, a recovery from an artificially low baseline. They are making a case for authentic structural growth over a multi-year horizon.
Okay, that makes sense. And that makes the next metric even more critical, in my opinion. Comparable store sales, or comps as they call them, grew by 5.6%.
Which is huge.
It is.
Yeah.
And just to translate for the listener, comps just means sales in stores that have been open for at least a year. So it filters out the revenue from brand new store openings. In an environment where major big box retailers are struggling just to keep their comps flat, pushing almost 6% growth from existing real estate is, it's significant.
It's massive.
But the number that truly dictates the health of the business is the traffic. Target's physical and digital traffic was up 4.4%. To me, that is the single most important data point in this entire earnings call.
Without a doubt. Because, look, for the last 24 months, the entire retail sector has been engaged in this really dangerous game of inflation-driven revenue masking.
Oh, explain that. What does that look like?
So a company would report, say, 5% revenue growth, and Wall Street would cheer. But when you dug into the details, their actual foot traffic was down maybe 3%.
Wait, so fewer people were in the store?
Right. Fewer people. They were simply charging 8% more for the exact same basket of goods to fewer customers. And I mean, that is a terminal trajectory.
Yeah, because you eventually run out of people willing to pay the higher prices.
Exactly. You can only squeeze the existing customer base with price hikes for so long before demand elasticity snaps, and they just abandon your store entirely. So Target generating a 4.4% increase in actual traffic, that means human beings are making the active decision to walk through the doors and choose Target over competitors.
So it's not just price inflation artificially boosting the revenue.
No, it represents pure market share capture, which is exactly what you want to see.
But capturing market share in physical stores is incredibly capital intensive, right? Which is why the digital side of this report is so fascinating to me. It reveals a much higher margin growth story.
The digital numbers were fantastic.
Yeah, overall digital channel sales grew 9%, and same-day delivery jumped an incredible 27%. However, hidden in those digital numbers is Target plus Cent.
Ah, yes. The third-party marketplace.
Exactly. This is their third-party marketplace, and its gross merchandise value, or GMV, shot up by 60%. We really need to drill down into why this specific 60% growth is fundamentally different from a 60% growth in their regular physical inventory.
Yeah, so think of traditional retail, like running a taxi service, right? Target has to buy the car, they pay for the gas, they hire the driver, and they absorb all the depreciation while just hoping a passenger actually pays for a ride.
That sounds incredibly expensive.
It is.
Yeah.
In a physical store, they own the inventory, they pay to ship it all the way from China, they pay to store in a warehouse, and they take the markdown risk if it doesn't sell at full price. But Target Plus, their digital marketplace, is more like a toll road. Target built the digital highway, right?
Yep.
And independent third-party sellers pay a toll to drive on it.
So Target doesn't even own the products.
Nope. If a seller lists, a giant patio furniture set on Target Plus there, the seller holds the inventory and the seller ships it directly to the buyer. Target simply collects a commission for facilitating the transaction on their website.
Wow. So it's completely asset-light revenue.
Exactly. And when you grow an asset-light segment by 60%, the profit flow-through is incredibly potent. I mean, they are monetizing the immense web traffic they already have without taking on a single dollar of inventory risk.
That's brilliant.
It is the core mechanism that made Amazon so incredibly profitable, and Target is just quietly scaling their own version of it in the background.
Which naturally leads us to the margin profile. So gross margin expanded by 80 basis points, hitting 29%. And just a quick translation, 80 basis points just means 0.8%. It sounds small, but in a $25 billion quarter, squeezing almost a full percent out of the top line is a massive cash windfall.
Oh, absolutely. The mechanics of getting to a 29% gross margin in such a hyper-competitive environment usually involves a mix of, fewer promotions, better inventory management, and lower freight costs.
Right. But here is the major caveat, and where I personally start getting a bit skeptical. That gross margin victory is getting immediately eaten by their operating expenses. SG&A, which is selling, general, and administrative expenses, crept up to 21.9%.
Yeah, and SG&A is essentially the cost of keeping the lights on and paying the staff. Jim Lee did note that last year's adjusted SG&A was 21.7% if you exclude a $600 million legal settlement benefit they recorded back then.
Sure, you always have to look at the adjusted numbers.
But even adjusting for that, the structural costs of keeping the lights on are rising. They are spending significantly more just to operate the basic business today than they were a year ago.
And yet somehow, adjusted earnings per share still came in at $1.71, which is a 32% increase year over year. So the tension here is super clear. Profits are up, but the absolute cost of doing business is accelerating fast.
Right. The expenses are chasing the revenue.
Exactly. It forces the question, are they basically buying this growth? If Target's traffic is up 4.4%, that's like a restaurant suddenly having a line out the door instead of just quietly raising menu prices.
Which is great.
Yes. But with SG&A expenses climbing to 21.9%, are they paying too much just to keep that line moving?
That's the billion-dollar question.
And during the Q&A, we actually got a glimpse into how management is defending that growth. Michael Lesser, an analyst from UBS, asked a highly specific question about the traffic pump. He essentially asked if this 4.4% surge was simply a result of previous boycotts fading and long-lost guests passively returning to the store.
Oh, I loved this moment on the call.
Right. Michael Fidelk, the CEO, completely refused to validate that premise. He dodged it entirely. His exact quote was, "I'd stop shy of that precision. What is in our control is clarity of strategy." It
was a fascinating evasion. I mean, let's look at the strategic reason for that dodge. If Fidelk admits that the traffic surge is just angry customers finally cooling off and returning to their old habits, he is admitting that the growth is entirely passive.
He's basically saying, we didn't do anything.
Exactly. It implies management didn't do anything to earn those sales. They just waited out a macroeconomic or social storm. By sidestepping the boycott narrative completely, management is forcefully demanding that Wall Street attribute the success to their active operational decisions.
They want the credit.
They want the credit assigned to their new merchandising and supply chain initiatives, not just shifting cultural wins.
Well, that brings us perfectly to the actual strategy they want all this credit for. Because we have to leave the CFO's financial spreadsheets now and virtually walk down the physical aisles with Cara Sylvester, the chief merchandising officer.
The fun part.
Yes, her entire strategy hinges on a very specific, singular consumer persona that she calls the busy family. I really want to talk about the psychology of this demographic because it dictates literally every inventory decision they are making right now.
The busy family demographic is the holy grail of big box retail. I mean, we're talking about households that have a reasonable amount of disposable income, but they live in a perpetual state of time poverty.
Time poverty. I like that phrase.
It's so true, though. They are balancing careers, childcare, school schedules, and household management. From a behavioral economic standpoint, these shoppers are experiencing profound decision fatigue.
Right.
By the time Saturday morning rolls around, they do not want to go to 3 different specialty stores to get their groceries, their kid's birthday present, and their skincare routine. They want a single, frictionless destination.
And Target is already pretty good at that.
They are. Target already captures a significant share of wallet from this group, but the current strategy is designed to deepen that entrenchment, to make it so they never even think about going anywhere else.
So let's look at how that psychological profile actually manifests on the physical shelves, starting with what they call their food forward strategy.
Yeah.
In just the first quarter, Target launched 3,000 new food items.
3,000 in 1 quarter.
It's wild. And sales from those specific items were up 50% compared to the prior assortment. But the detail that really highlights their deep understanding of the busy family is the elimination of certified synthetic colors from their entire cereal assortment.
See, that is a massive supply chain and vendor management maneuver. You don't just snap your fingers and remove red dye 40 from the cereal aisle.
Right, because they don't manufacture most of that cereal.
Exactly. It requires forcing massive CPG conglomerates, the huge companies that make this stuff, to reformulate their products specifically for your shelves. Or, alternatively, aggressively expanding your own private label brands, like Target's Good and Gather, to replace the national brands that refuse to comply.
That's a huge flex of their retail muscle. And the trust-building aspect of that decision is just phenomenal. Think about it. If you are an exhausted parent, you want to buy the fun, colorful cereal for your kid, but you carry this ambient guilt about feeding them synthetic ingredients.
Right. You've read the articles. You feel bad.
Yeah. Target is basically acting as a curator here, actively removing the guilt from the purchasing decision. They are making the safe choice, the easy choice. You don't have to stand there and read the labels in the aisle because Target already did it for you.
It's brilliant.
It builds a level of brand loyalty that transcends mere price competition. I mean, you'll pay a little more for that peace of mind.
And they're applying that exact same curation and trust-building model to the single most critical demographic entry point in retail history, the baby aisle.
Oh, this was fascinating.
They rolled out 2,000 new items in baby and kids, deliberately creating a $1 entry price point to capture the value-conscious shopper. But simultaneously, at the exact same time, they're pushing premium service. They introduced what they call baby beacons to aid in-store discovery.
And what are those exactly?
Basically, visual and digital cues to help stressed parents navigate the baby section easier. But the crazy part is, in 200 select stores, they are testing a dedicated baby concierge service.
Wait, a physical concierge in a big box store, like a hotel.
Basically.
That's wild. But from a customer lifetime value perspective, the birth of a first child is the exact moment. Brand loyalties are entirely up for grabs. I mean, a new parent doesn't know which strollers fold easiest, or which bottles reduce colic, or which diapers fit best.
They are completely overwhelmed.
Right. So if Target can step in and actually hold their hand during that highly stressful, highly emotional period, they are securing a customer not just for the infant years, but for the next 18 years of school supplies and apparel and groceries.
And the math backs up the theory. Cara Sylvester explicitly noted on the call that following these rollouts, they saw a more than 5 percentage point acceleration in baby comm trends in the back half of the quarter.
Wow.
Yeah, that is immediate, undeniable validation of the strategy.
And we see the same aggressive curation in health and wellness too. Over 70% of Target guests shop this specific aisle. So what do? They added 1,500 new items and are currently refreshing 40% of the entire assortment.
That's huge turnover.
It is. They are ripping out the stagnant legacy brands and replacing them with functional beverages, trending clean protein snacks, and better-for-you alternatives. They are actively managing the life cycle of their inventory to match the cultural zeitgeist.
But Target has never been solely about utilitarian needs like milk and diapers. The brand's unique differentiator, the reason it constantly generates viral memes about walking in for toothpaste and leaving with a $200 receipt, is the thrill of discovery.
The famous Target run.
Exactly. They cultivate FOMO, or fear of missing out, better than almost any other physical retailer out there.
Yeah, the fandom in pop culture drops. In Q1 alone, they executed exclusive, limited-time collections with Park, Roller Rabbit, a massive cross-category Pokemon collaboration, and a BTS K-pop launch.
The K-pop launch was huge.
CEO Michael Fidelk noted he woke up 3 times this year to see literal lines of people wrapping around store exteriors before opening hours. You cannot buy that level of organic, rabid social media engagement with a traditional television ad spend. It drives immediate, high-margin foot traffic.
It really does.
Yeah.
But they are balancing those premium, culturally relevant drops with an aggressive defense of their value proposition, particularly in discretionary categories like toys.
Right.
They drove double-digit comp growth in toys, and the engine behind that growth was items priced at $20 or less with a really specific focus on the $5 to $10 range.
Which feeds right back into the busy family persona we were talking about.
Okay.
A parent is there buying the newly reformulated dye-free cereal, and they let their child pick out a $5 toy just to avoid a meltdown in the checkout lane. It's a low-friction add-on that drives volume.
It's the modern equivalent of candy at the register.
Right. But as Talk Tickers hosts, we have to look at the entire ledger. And the ledger has some incredibly dark spots right now. The laggards.
Yeah, the traditional cash cow categories. Home and apparel. Despite the massive wins in food, baby, and pop culture, sales in home and apparel are currently tracking below 2024 levels.
Ouch.
Yeah, they are actively bleeding revenue in the categories that historically provided their highest profit margins. Selling a decorative throw pillow or a summer dress yields significantly more profit per square foot than selling a gallon of milk or a box of diapers.
So what is the remediation plan there? Because Cara Sylvester announced a multi-year reinvention for home. This quarter alone, they are liquidating and replacing 75% of their decorative accessories assortment.
75%.
That is staggering. That means they got the trend forecasting completely wrong over the last cycle, and they are taking the pain of a massive inventory wipeout just to reset the floor.
Yeah.
Furthermore, they are overhauling the beauty department by building out new Target Beauty Studio concepts in over 600 stores this fall.
It is an aggressive level of physical disruption to the store environment.
And here's where I really have to push back on this entire merchandising narrative. They are deploying baby concierges. They are actively curating synthetic dyes out of the food supply. They are building dedicated beauty studios. It sounds like they are trying to become the Whole Foods of general merchandise.
Apparently you're trying to go premium on the experience.
But can you actually scale high-touch premium boutique service across thousands of massive big box stores without absolutely obliterating your operating margins?
See, that is the exact friction point where merchandising collides with operations. It's easy for a chief merchandising officer in Minneapolis to design a beautiful high-touch baby concierge program on a whiteboard.
Sure, it looks great in a slide deck.
Exactly. It is an entirely different reality to execute that program in a 130,000 square foot suburban store on a Tuesday evening when 3 employees have called out sick, the checkout lines are backing up, and a massive pallet of inventory needs to be unloaded.
Which brings us perfectly to part 3 of our analysis, operations, and supply chain. Because an incredible merchandising strategy is worthless if the customer walks into a chaotic store and the shelves are just empty.
Yep.
This is where the new Chief Operating Officer, Lisa Roth, steps in. She's been with the company for 20 years, and her assessment of the physical stores was brutally honest. She pinpointed 2 catastrophic friction points: product findability, and out of stocks.
We all know the experience. You check the app, it says the specific organic milk you need is in aisle G4. You walk to G4 and there's just an empty gap on the shelf with a barcode staring back at you.
It's incredibly frustrating.
Lisa Roth highlighted that this failure is most pronounced in high-velocity categories like fresh food during peak shopping hours, so evenings and weekends.
Which are the exact windows when the busy family is actually in the store. If a working parent carves out an hour on Saturday morning to do their weekly run, and you don't have the specific diapers or milk they need, you haven't just lost a $15 transaction.
No, the damage is much worse.
You have broken the trust that the CMO just spent millions of dollars trying to build. Next week, that parent will just bypass Target entirely and go straight to a dedicated grocery store.
And to solve this, Target is deploying a mix of advanced technology and massive physical infrastructure. On the tech side, they are implementing AI for hyper-local demand forecasting.
How does that differ from what they do now?
Well, traditional retail supply chains are highly reactive. A store sells 10 boxes of cereal, the system registers the drop in inventory, and it triggers an order for 10 more boxes to be shipped from a distribution center.
So it's always playing catch up.
Right. But AI forecasting shifts the model to predictive. It analyzes localized data stuff like weather patterns, community events, historical seasonal shifts to predict that a specific store in a specific zip code is going to see a spike in demand for, say, umbrellas or a specific brand of sunscreen. And it moves the inventory before the shelf ever goes empty.
Okay, but the algorithm still needs physical logistics to actually move the boxes. And the supply chain investments are staggering. They just opened a massive new food distribution center in Colorado, specifically to handle the velocity of fresh, perishable items.
That's a huge capital expense.
It is. Even more critically, they opened a new receive center in Houston that is designed to process 25 million cartons annually. Let's explain the mechanics of a receive center versus a standard distribution center, because it fundamentally changes how they hold inventory.
Yeah, so a traditional distribution center takes goods from suppliers, breaks them down into smaller batches, and ships them directly to stores. A receive center acts as a massive upstream holding pen.
Upstream holding pen. Got it.
It allows Target to take possession of long lead time inventory like patio furniture ordered from Asia months in advance and hold it centrally. Instead of jamming the back rooms of individual stores with seasonal inventory weeks before it's actually needed on the floor, the receive center holds the bulk.
Oh, so the store backrooms aren't overflowing.
Exactly. And then the AI algorithms dictate the precise moment to flow that inventory down to the local distribution centers and into the stores. It keeps the store backrooms clean and drastically improves the efficiency of the employees trying to restock the floor.
And to manage this sheer volume, they hired Jeff England as their new Chief Global Supply Chain and Logistics Officer, pulling talent from outside the organization to architect a step function change in their physical logistics.
It's a massive overhaul.
But all of this upstream infrastructure exists to serve one specific node, the physical store. Lisa Roth dropped a statistic that every investor listening to this needs to understand. 95% of Target's digital sales are fulfilled by their physical stores.
That number is just wild. When you order an item on Target.com for delivery or for Drive Up, there is a 95% probability it is not being packed in some highly automated million-square-foot warehouse out in the desert.
Right.
No, a Target employee is physically walking the aisles of your local store, pulling the item off the exact same shelf a regular customer shops from, putting it in a bag and bringing it out to your car or shipping it out.
So the store is literally the warehouse. It's a hybrid facility. And because of that, they are pouring a biblical amount of capital into the physical footprint. They're opening 30 new massive stores this year, ranging from 125,000 to 150,000 square feet.
Those are huge formats.
They're executing 100 deep remodels of existing locations. They're rolling out updated My Device handheld technology to over 300,000 team members so they can actually track the inventory in real time. But the number that caused an audible gasp among Wall Street analysts was the labor cost. Target is investing $2 billion to $3 billion in store payroll.
Yeah. Lisa Roth framed it as putting the hours where the workload is. They are heavily staffing the nights and weekends.
The peak hours.
Exactly. The goal is to ensure employees have the time to actually restock the shelves, process the digital orders, and provide that concierge level of service to the guests, rather than running around perpetually understaffed and just putting out fires.
Wait, hold on. $2 to $3 billion? In retail, where net margins are already razor thin, That doesn't sound like a strategic optimization. That sounds like panic.
It's a massive line item.
It is. You cannot simply undo a multi-billion-dollar wage increase. This is a permanent drag on the income statement. While Amazon is aggressively automating everything from fulfillment to checkout, Target is choosing to spend billions manually throwing human labor at the problem. Will Wall Street investors actually tolerate this massive human capital overhead? How are they possibly justifying this massive ongoing operational expense to their shareholders?
They are justifying it as the ultimate differentiator. Target management fundamentally believes that the physical, tactile experience of a clean, fully stocked, well-staffed store is their only viable moat against Amazon.
Because they can't beat Amazon on infinite selection.
Exactly. If the store experience degrades, Target has no reason to exist. Yes, it is a colossal hit to the operating margin, but they are gambling that the long-term customer loyalty and the subsequent market share capture will eventually outrun the payroll costs. They are choosing human capital over clinical efficiency.
That is a massive gamble, and it brings us directly to part 4, management guidance. We have looked at the revenue, we've dissected the merchandising philosophy, and we've debated the terrifying cost of their supply chain and labor overhaul. Now, what is Jim Lee telling Wall Street to expect for the rest of the year?
He is threading a very delicate, highly calculated needle here. He is projecting full-year confidence, but aggressively waving caution flags for the immediate term, specifically the upcoming second quarter.
The Q2 headwinds. Let's look at the mechanics of this warning. Jim Lee explicitly told analysts that Q2 is going to be the hardest comparison of the year. Why? Because last year, in Q2 2025, Target benefited from a massive singular retail event, the launch of a Nintendo Switch 2 console.
It is crucial to understand how a single hardware cycle can distort the baselines of a multi-billion-dollar corporation.
Right, because video game consoles don't launch every year.
No, they don't. The Switch 2 launch was a global phenomenon. It drove hundreds of millions of dollars in highly concentrated revenue in a matter of weeks. Simply not having a comparable console launch this year creates an artificial 2 percentage point deficit in their growth projections.
Wow. 2 whole points.
Yeah, it's like trying to beat your batting average from a year where you hit 50 home runs. The baseline is inherently skewed.
It creates an illusion of shrinkage. But algorithmic trading programs don't always contextualize hardware cycles, right? A computer program scraping the earnings release just sees Q2 sales dropping 2% and triggers an automatic sell-off.
That's a real danger.
And on top of that, management warned that the spending bump we saw in Q1 was heavily subsidized by unusually high tax refunds hitting consumer bank accounts earlier this year. And that liquidity is going to evaporate as we move into the summer months.
Yet, despite spending a significant portion of the Q&A terrifying the analysts about a soft Q2, Jim Lee immediately pivoted and issued full-year upgrades.
That is the whiplash. They literally raised their full-year sales guidance to a 4% increase. That is an upgrade of 2 full percentage points from their prior guidance, and they stated that earnings per share is now expected to hit the high end of their $7.50 to $8.50 range.
If you want to know what management actually believes, look past the verbal guidance and follow the capital allocation. Follow the money.
Always.
They have a $5 billion capital expenditure budget for the year. That is the hard cash paying for the 30 new massive stores, the Colorado distribution center, the beauty studios, and the technology rollouts. They already deployed $1 billion of it in Q1 alone.
Then there is the dividend. Target is highly protective of its status as a dividend payer. In Q1, they distributed $516 million to shareholders, which represents a 1.8% per share increase.
Which is a nice bump.
Yeah. And they signaled to Wall Street that they intend to ask the board for an additional increase later this year, aiming for a long-term target of paying out 40% of their earnings as dividends. But the most revealing capital allocation metric was what was missing. They executed absolutely 0 share repurchases in Q1.
Not a single share bought back. Jim Lee stated clearly that they are hoarding cash to protect their middle-A credit ratings. They are prioritizing a fortress balance sheet, leaving the door open for potential buybacks later in the year if the macro environment stabilizes.
I have to challenge this narrative. I mean, they raised their full-year guidance, projecting extreme confidence in the back half of the year, but they spend the call warning about Q2, warning about tax refunds fading, and hoarding cash instead of buying back their own stock. It feels like a driver slamming the gas pedal while constantly staring nervously into the rearview mirror.
It's a mixed message for sure.
Right. Are they actually confident in this busy family strategy, or are they just intentionally sandbagging Q2 expectations to set a ridiculously low bar that they can easily step over later?
It is almost certainly a strategic sandbagging. It's the classic corporate maneuver under promise in the short term to over-deliver later.
Manage the expectations.
Exactly. They know the algorithmic traders are going to panic over the Nintendo Switch overlap regardless of the underlying business health, so they are preemptively taking the air out of the balloon. But the fact that they upgraded the full-year outlook and maintained a massive $5 billion capex spend, that shows a genuine structural belief that the merchandising and supply chain overhauls are sticky and will generate long-term yield.
Which brings us to the ultimate reckoning, the bottom line. This is where Talk Tickers makes it actionable for you, the listener. Based on the data, the strategy, and the massive costs involved, what is the verdict on the ticker TGT? Let's lay out the bull case and the bear case.
Well, the bull case, the argument for holding or accumulating the stock, is built on the authenticity of the turnaround. A 4.4% increase in traffic proves that the market share capture is real. Consumers are actively choosing the Target experience.
The actual bodies are in the store.
Right. Furthermore, the merchandising pivots, specifically the 3,000 new food items, the removal of synthetic dyes, and the baby category overhaul, are generating immediate returns. They have perfectly isolated and captured the highly lucrative busy family demographic.
And the bulls will also point to the hidden margin engine we discussed. Target plus Famba. Growing a third-party digital marketplace by 60% is an asset-light, highly profitable revenue stream that the broader market is currently undervaluing. If Target can continue to scale that toll road model, it fundamentally alters their margin profile for the better. But the bear case is incredibly compelling, and it centers entirely on the cost of execution. If Target is a house, they just completely renovated the kitchen with this new food and baby push, and it looks beautiful. But the roof, the legacy cash cow categories like home and apparel, still has some major leaks. They are actively bleeding.
And reversing that trend requires a multi-year reinvention and a 75% inventory wipeout, which carries immense execution risk.
And the sheer cost of manufacturing this turnaround is exploding. You cannot simply ignore $2 to $3 billion in added store payroll, a $5 billion capex budget, and SG&A creeping up to 21.9%. They are spending a fortune to keep the shelves stocked and the stores clean.
And if consumer spending suddenly contracts in the back half of the year, those fixed labor costs will act like an anchor on their earnings. Furthermore, the immediate Q2 algorithmic risk from the Nintendo Switch overlap guarantees short-term volatility.
So here is the actionable Talk Tickers verdict. Are you buying the house today or waiting for the inspection to clear next quarter? If you currently own Target, it is a solid hold as a long-term dividend compounder. The traffic growth validates the brand's relevance, and management is relentlessly committed to driving toward that 40% dividend payout ratio. But if you are looking to initiate a new position, do not buy the stock today expecting a massive pop, wait out the summer. Let the algorithmic traders throw their inevitable tantrum over the Q2 Nintendo overlap and look to acquire shares at a cheaper entry point in late summer, just before the high-margin holiday season kicks in.
The underlying strategy is sound, but the price of executing that strategy is immense, and patience is the correct play here.
We've covered the numbers, the aisles, and the balance sheet. But before we wrap this deep dive, there is a larger provocative question that this earnings call really forces us to confront. Look at the aggregate moves here. They are deploying hyperlocal AI to predict demand. They are building massive receive centers capable of processing 25 million cartons upstream. And they are aggressively scaling a third-party digital marketplace at a 60% clip.
It really begs the question, are we witnessing the quiet death of the traditional big box retailer?
Exactly.
Is Target attempting to mutate into an Amazon Lite hybrid? I mean, they are trying to perfectly fuse the tactile, physical joy of discovering a $5 toy or an exclusive K-pop drop in a beautifully staffed store with the infinite high-margin asset-light inventory of a digital marketplace.
If they can successfully execute that hybrid model without bankrupting themselves on payroll in the process, they aren't just fixing a leaky ship. They are building an entirely new class of retail vessel. Thank you for joining us on this deep dive. We hope we helped you decode the mechanics behind the numbers and gave you a clearer lens to view the massive shifts happening in the retail landscape. Keep questioning the data, and we'll catch you on the next deep dive.